everybody, I'm calling this talk Automated Trading Systems, the whys, the whats, and the hows. I'm going to cover a lot of material here, but first let me begin by giving you a little bit of background on me. I call myself a techpreneur, as every business I've ever started over the past 2 decades has been in the field of technology and has been primarily online. I'm the founder and president of companies such as Register Everywhere Inc., SoSpuz Inc., along with a few others. As for my educational background, I started as a computer science major, then switched to business administration, ended up with an MBA. As for my trading, I've been trading since 2001, and I've primarily traded equities, options, and futures. I'm also the principal at Pinnacle Quant LLC, a commodity trading advisory firm. I'm licensed, registered with the CFTC, and a member of the NFA. I'm also the developer of Market Volatility Harvester, a self-directed, fully automated trading system. So let me just quickly go over some disclaimers. Futures trading involves substantial risk of loss and is not suitable for all investors. Past results are not necessarily indicative of future results. The high degree of leverage that is often obtainable in futures trading can work against you as well as for you. The use of leverage in futures trading can lead to large losses as well as profits. Futures trading is not suitable for all investors and involves the risk of loss. You must be aware of the risks of futures trading and be willing to accept them. Don't trade with money you cannot afford to lose. I will cover a variety of different products and services in this presentation. These products and services are not recommendations to use said products and services, but rather they are products and services that I prefer and or personally use. Any material covered in this presentation that does not include a source is not a statement of fact, but rather my personal opinion. And of course, we have the standard hypothetical performance disclaimer. Please take a second to read that. Okay, let's jump right in. So what are some of the advantages of automated trading? First on the list is that it reduces emotion. In my view, all manual traders battle their emotions. Should I go in? Should I exit? Should I increase my stop? Should I decrease my stop? Am I too late? Am I too early? Everything can be hunky-dory when you're trading in simp mode. But when you put live cash money on the line, something happens. Your emotions take over. Even if you have a well-defined plan, you've written down everything that may transpire in your trade, and on paper you are ready for any scenario, win, lose, or draw. But as soon as you see the time and sales data, green bars and red bars coming in and out in a hurry, you get nervous. All us mere humans do, because real money is on the line, and your adrenaline is pumping, your mind is in fight or flight mode. Imagine this hypothetical. You're in a long trade and you're up 10 handles, so that's $500 a contract. But in the very next bar, you get a huge red bar that takes off 8 handles from your unrealized profits. You get nervous and immediately exit your position with a small 8-tick win. Profit is a good thing, but that celebration doesn't last, as in the next 5 minutes of trading, you watch the market rip-roar another 40 handles in the direction you were in just a few minutes ago. And you could have made all that money, but you didn't, because you got scared of giving back profits and you exited. This exact hypothetical scenario that I just described has happened to me several times when I was trading manually. It is very difficult, even for seasoned traders, to be in total control of their emotions. I mean, which one of us mere humans can completely ignore our emotions and exclusively use logic like Spock from Star Trek? We are humans. Emotions are hardwired into our systems. Using an automated trading system mitigates the emotional-based decisions. The automated system does the execution of entries and exits for you. In the case of Market Volatility Harvester, it is a self-directed automated system where you put in your profit target, stops, net session loss limit number, whether you want to incorporate historical range frequency stats data to the trading logic of the system. And upon you making those inputs and you enabling the software, the system runs by itself. By the way, I will be covering these inputs shortly in this webinar. Once you enable the software, you can sit back and watch what it does. Now you will notice I stated mitigates. It doesn't completely solve the problem of emotional trading, because you can still override the system and manually exit because it is your software and you are in control of what you do with your software. Next, saves time. Back in the day when I used to do manual trading, I would wake up at 5 a.m. I'm in Los Angeles, so Pacific time, and I would look for any trending stocks as I kept an eye on the E-mini SPOOs and the VIX. I would glance at news, check out places like StockTwits to see what the hubbub was for that day. My manual strategy was a mix of an event-driven approach combined with technical analysis based on price in volume. Imagine doing that full-time every single trading day while running a business with a staff of 7. It takes time. I would essentially try to set up trades and would almost always try to exit my trade before I went to my actual job. I wanted to automate the process, ignore the noise of people pumping their individual stocks, and just focus on patterns and technicals. So I wrote the automated trading system for myself because I didn't want to spend hours glued to a screen, hunched over, hurting my neck, lacking sleep, way over caffeinated, looking to make a decision if I should go long or short or just stay on the sidelines. With an automated system, one can skip all of that and save a bunch of time. Next, backtesting. Automated systems can provide you with ample opportunity to backtest your strategy and see if your idea would have worked over a long period of time and over many trades. Now, I recommend backtesting for at least 10 years, and the system should make about 5,000 trades during that period. That is essentially what I have done with Market Volatility Harvester. Remember though, past results are not necessarily indicative of future results, and hypothetical results can be quite different than actual results. Next, disciplined approach. This is key. When I was manually trading, I made a commitment to myself that I would keep a spreadsheet of all my trades, entries, exits, stops, wins, losses, commissions paid, net profit, etc. I would do that for a few weeks and then slack off. Why? Because it takes time. What's more, when a human loses, the human tends to get frustrated and doesn't want to be bothered with documenting the loss during the time they're trying to cope essentially with their loss. It is easy to say that I'm going to keep a detailed journal of my activity. It is another matter to consistently do that. In other words, these pesky emotions get in the way of a trading process. Moreover, when a human trades manually, the news of the day may impact their decision-making process. For example, some people went short the market and posted on Twitter and elsewhere that COVID virus is going to decimate the market over the next few months. However, since March of this year, the market has experienced a V-shaped recovery, and as of this talk, and today we're August 21st of 2020, we are trading at near or all-time highs. News trading or event trading can be finicky and deliver unpredictable outcomes. However, when you use an automated trading system, there is a set of logic already built into that system, and that system will automatically execute trades and do so discounting all the quote-unquote noise. Next, disadvantages of automated trading. Now, automated trading is not all positive. There are some negatives. So some of those negatives can be mitigated, others cannot. Let's discuss mechanical failures. Computers may freeze or fail completely. Routers fail and may go into permanent reboot cycle. Software may freeze. Your data provider's servers may go down. Electricity may fail. Some of these disadvantages can be mitigated, others cannot. It all depends on how much resource and effort you want to put into your trading environment, which I'll discuss in the next slide, and what your backup plan is if things become immediately unfixable. For example, if your computer freezes and you have no option but to reboot your computer, there are settings within NinjaTrader that you will need to familiarize yourself with, particularly under tools, options, strategies, and you'll need to set it so that the Ninja script, in other words, the system, knows what to do in cases of a disconnect. Next, internet connection loss. Imagine all of a sudden the bars on your 1-minute chart stop moving. You may have lost your internet connection. I discuss internet connection failover in the next slide, but losing an internet connection can be scary in the middle of a trading day. What that means to any automated trading system, Market Volatility Harvester included, is that the programmed exits that depend on a live internet connection will not fire off. You still have your stop price and price targets, which get submitted in Market Volatility Harvester immediately to your broker upon the entry of a trade, and are essentially sitting on your broker's servers, but you are missing out on the technical exits. What can you do? First, determine if the internet connection failover is a temporary hiccup and your router is simply rebooting itself, or if the internet connection loss is going to be a sustained issue. Either way, you should have your broker's number handy, as you may need their assistance in exiting the trade. Next, monitoring. I personally believe that all automated systems need to be manually monitored several times throughout the day. I used to use TeamViewer in this regard and would just connect to my trading machine whenever I was out and about just to see if everything is working, meaning my computer is up, my internet connection is up, etc. I always watch my trades a few minutes before the CME US Index Futures ETH session closes, as Market Volatility Harvester exits all trades 1 to 5 minutes before the 1 hour break, which is at 2 p.m. Pacific Standard Time. In the next slide, I'm going to discuss both automated and manual monitoring in great detail, so let's move on to curve fitting backtests. I routinely get asked this question, Rafi, what are the perfect settings that I should use for my stop and price targets, as well as my net session loss limit number? The reason I never specifically answer this question is because my stop, my price targets, and my session loss limit numbers are a function of my risk to reward tolerance, and are not necessarily based on the quote-unquote best past hypothetical performance numbers. During backtesting, some people get really hung up on trying to maximize the quote-unquote best hypothetical performance results, bypassing the fact that when real money is on the line, and let's assume they had a really wide stop, they are likely to panic and potentially make a mistake. So avoid curve fitting. Next, missing breaking news events. Sometimes you get breaking news, and every news station is covering this particular event. These type of event-driven situations can significantly move markets in either direction. An automated system that is news indifferent, like Market Volatility Harvester, may miss these types of events. Setting up your automated trading environment. I discussed some of the disadvantages of automated trading systems. Now let's discuss setting up your trading environment and see if we can mitigate some of those disadvantages. Let's start with computing power. This is essentially the foundation of you running your automated trading business, and that is what I call trading, a business. There are logistics, risk capital, and expenses in every business, and all of those have to be managed. But you can't trade without a computer, so it all starts with computing power. So there are minimum requirements that you can find listed on the bottom of Pinnacle Quant's fully automated trading page, but I'm going to cover specs on what I like to see. For those of you that have put a lot of thought and energy behind setting up your current trading environment, kudos. Hang in there just for a few minutes as I cover this material for those that don't have a proper automated trading system set up just yet. There are several elements within the topic of computing power, and I will briefly touch upon all of those elements next. Let's start with the OS. So in my view, the operating system should be Windows 10 Professional 64-bit. That one is pretty easy. Next, in my view, the system should have at least 16 gigs of memory. It's not uncommon to hear about traders that run 64 gigs of memory on their machines, but unless you are running other applications concurrently with NinjaTrader, 16 gigs should do just fine. Next, let's talk cores, multi-threading, and processing power. So late model desktop Core i5 and Core i7 chips have 6 cores. NinjaTrader 8 is multi-threaded and can, in theory, utilize all available cores of your processor. But keep in mind, NinjaTrader's multi-threaded design is that each instrument is assigned to a thread, and all windows with that instrument will run on that same thread. So if you have 10 charts with 10 separate instruments, then NinjaTrader will run 10 threads. If you have 10 charts, one instrument, it will run one thread. So don't go overboard on core if you are essentially trading one instrument. However, if you are in fact trading 10 instruments, then check out Intel Core i7-6950X, which has 10 core. Next, let's talk graphics cards. Some traders insist on buying high-end expensive gaming cards. In my view, it is not necessary to do so. This topic is a bit controversial, so I'm going to share my thoughts, and hopefully that'll give you a good starting point for your research. If you are running one screen, then check out the GT710 graphics card. If you are running between 2 and 6 screens, then check out the GT1030 card. You would be running this on a 3-card system. If you are running between 8 and 12 screens, then check out the NVIDIA M2000, which runs 4 screens per card. If you have more than 12 screens, then you may have too many screens. Just kidding, but seriously, if you have more than 12 screens, then you are probably pretty happy with your setup already. Next, let's quickly discuss disk space. I like solid state drives over hard disk drives as SSDs have no moving parts and thus have less chance of failure. Next, internet connection. I have received several phone calls over the past few months of people inquiring if it is necessary to have a stable internet connection to trade with Market Volatility Harvester. The answer is, to trade any automated trading system, you must have a stable internet connection. And that means having a direct connection to your trading machine and not relying on your Wi-Fi. Now, once in a while, connections are lost, and I will be discussing failover momentarily. But there are steps you can take to ensure that you have less potential of an internet connection loss or degradation. First, call up your provider and get a dedicated or static internet connection. The cheap connections where they bundle you for $39 or something are generally dynamic connections, meaning your neighbors are on the same line. So if they all decide to binge on Netflix, your connection is going to get slower. If upgrading to a dedicated connection is not a possibility in your area, then you may want to consider outsourcing computing operations to a web hosting provider that offers Windows-based virtual dedicated servers. Next, router failover. I have a detailed write-up on this, and I have linked it to the bottom of Pinnacle Quant's fully automated trading page. But as a synopsis, you will need a router that has failover capabilities. That means when your main internet connection goes down, your router will seamlessly and automatically transfer your internet connection to your backup line. In my write-up, I note the router I personally like, which is the Teltonika RUT 950 LTE 4G router. Here's the gist of how this router works. You have your main internet connection line, but on the back of the router, you also have 2 slots for SIM cards. So you call up AT&T and or T-Mobile, rent a mobile line from them, which will essentially be a 4G line. They provide you with a SIM card, and you insert that SIM card in the back of the router. So if and when your main internet connection line goes down, the router recognizes that disconnect and automatically switches you to the SIM card. Next, computer and connection monitoring. Some people prefer to completely automate monitoring. Others use a hybrid approach. Fully automated monitoring can be accomplished a variety of ways, but all of those ways will ultimately require manual intervention if something is in fact wrong with your computer and or internet connection. One such monitoring tool that you may wish to research is called PRTG by Passler. Their website is passler.com, so that's PAESSLER.com. PRTG will essentially ping your devices and alert you if something is wrong. They offer tons of information in this regard. Another approach is to write a ping recipe on IFTTT.com. If you Google for ping IFTTT recipe, you will get tutorials on exactly how to do that. Personally, when it comes to Market Volatility Harvester, I like to check on trades once in the morning, once around noon, then once more a few minutes prior to the 1-hour session break, which happens at 2 p.m. Pacific Standard Time. Why do I do that? Because in Market Volatility Harvester, all positions are closed within 1 to 5 minutes prior to the 1-hour session break. In essence, I am watching trading and my computer to ensure my trades are flat before the session closes. Next, backup power options. So in my view, it is essential to have UPS batteries to which you connect your computer, your monitors, and your router. When shopping for UPS batteries, whatever number of minutes of power availability they tout, in my view, it is safe to assume it will not last as long as the number on the packaging reads. As such, try to divide devices on several UPS batteries to get the maximum amount of juice out of each of them. I personally use UPS batteries, but I also have a standby power generator on site in case I experience longer periods of downtime. It is relatively expensive to put in a standby power generator, so just distributing your devices over 2 or 3 good UPS batteries should buy you enough time to decide if you would like to exit and turn off your system until such time you determine your electricity is consistently available again. How to use Market Volatility Harvester. Let's start with what this strategy is and what it does. So Market Volatility Harvester is a long-short day trading strategy that goes both trend and counter-trend depending on the setup. Long-short means the system is designed to go both long and short. The strategy is formulated based on a combination of price patterns, technical signals, and statistics. Market Volatility Harvester is designed to trade on the 1-minute time frame. Market Volatility Harvester is designed to exclusively trade the E-mini S&P 500 futures. One part of the trading algorithm relies on price, not just the price of ES, but the tick price, and all those applicable calculations are happening based on the assumption that each tick is $12.50 and each point is $50. Remember, the E-mini S&P 500 futures is a levered product, and it's priced at 50 to 1, so each 1-point move is worth $50. Next, I'd like to discuss the advantage and disadvantages of trading the E-mini S&P 500 or the E-mini SPOOs as some traders call them. One obvious advantage of trading the E-mini SPOOs is liquidity. The E-mini SPOOs are highly liquid and trade approximately on average 1 million contracts per day. There are regulatory exchange limits on the number of E-mini SPOOs contracts one can hold at any one time, but that number is currently at 300,000 contracts. The next advantage is efficiency. The E-mini SPOOs are centrally regulated and are fully electronic. The E in E-mini S&P 500 stands for electronic. What's the advantage there? Well, you have no trading pit and no market makers. Another advantage of the E-mini SPOOs is that there is no restriction on going short. For those who trade equities, you may have gone through the experience of wanting to borrow shares from your broker and go short on that stock, but you've been advised they have nothing available for you to borrow. You don't have problems like that when trading the E-mini SPOOs. The next advantage, which by the way can also be a disadvantage, is that the E-mini SPOOs are levered. You need relatively little money to control a sizable unit. However, that can be good and bad. If the E-mini SPOOs move a point in your favor, you can be up $50. If the E-mini SPOOs move a point against your position, you can be down $50. To those that have watched or traded the E-mini SPOOs, you know that between all the zigging and zagging during the day, it potentially churns through hundreds of points in a given trading session. The next advantage is a tax disadvantage. Unlike equities, futures are taxed at a blended rate of 60-40. 60% of your profits are taxed at the lesser long-term capital gains tax, while 40% of your profits are taxed at the short-term capital gains tax. As those of you that trade equities can attest, if you hold your stock position less than a year, 100% of your profits are taxed at the higher short-term capital gains tax rate. So what are some of the disadvantages of trading the E-mini SPOOs? I just mentioned one of them, that it's a levered product. So if the price moves against your position at $50 a point, your losses can add up quickly. Technically, it is possible for someone to lose more than the money they put in if all things go wrong, including things potentially going wrong with the servers of the exchange. To mitigate some of that, I recommend trading with stops and use a quote-unquote shut off the system monitor and number if your net loss for a day reaches a certain number. Market Volatility Harvester does come with such a feature, which I will be discussing in greater details shortly. Another disadvantage is that the amount of money you need to put up, especially in an overnight trading system such as the Market Volatility Harvester, by way of the exchange-regulated overnight initial margin requirement. So as of this webinar, that number is 13.2, so let's just say $14,000 per contract. And you need to leave yourself a buffer to ensure if you have a bad month or two that you'll still have enough money in that account to keep going. I recommend having at the very least 1.5 times the initial overnight margin requirement number when utilizing Market Volatility Harvester. Okay, Market Volatility Harvester parameters. So in the next slide, I'll cover stops, price targets, the net session loss number I alluded to earlier, as well as the range frequency indicator. What I'd like to do is switch to Market Volatility Harvester so you can see the actual parameters. Now I need to state from the start here that the numbers you see listed in these parameters are not in any way a recommendation or a suggestion to use these particular numbers. These numbers represent the settings I personally use, and each of these parameters are editable and should be changed to meet your defined risk to reward objectives. Okay, so let's discuss what these parameters represent and how you can use them. Let's get the easy stuff out of the way first. So quantity is pretty obvious. This parameter represents the number of contracts you can trade. With Mach 1 and 2, you can trade 1 contract. In Mach 3, you can trade up to 5 contracts. Next, let's quickly go over price targets. So we have profit target ticks long and profit target ticks short. These are my limit order profit targets, which are set in ticks. These are obviously editable numbers, but I personally like to keep my profit targets really high. Why so high? Well, a couple of reasons. First, I have a bunch of technical market order exits programmed into the system, which will fire off if price hits or bounces off those technical areas. Moreover, I also have a time-based exit, where all open positions are closed approximately between 1 to 5 minutes prior to the end of the CME US Index Futures ETH session. My second reason as to why I personally like to keep high profit targets is because once in a great while, believe it or not, it gets there. And that feeling of hitting a Grand Slam home run, though it happens so rarely, is still worth it for me. Having stated all of that, you can set whatever price targets you are comfortable using. Now let's discuss the always controversial topic of placing a stop. Some people think every stop gets stop hunted. As such, they take huge risks with no stops. Others look at a quote-unquote support or resistance line and place their stop some X numbers of ticks away from that line. Yet others look at the ATR indicator and try to come up with some multiplying factor as to what their stop should be. After years of training and analysis, I came to the conclusion that for me, a stop has to be a set number that is based on my risk to reward expectations, and that there is no magical formula in placing the quote-unquote perfect stop. The way I think about stops is that I am willing to take relatively small losses on trades in return for the possibility of a run that has the potential to garner a relatively large return at some multiplying factor of my risk. I am personally okay with losing $250 in any given trade, and I am okay losing up to $2,000 of my risk capital in any given trading day. That's me, and that's my personal risk tolerance. Your risk tolerance may be higher or lower than mine, and that is something you have to look at and compare that number to your initial risk capital number. So what is risk capital anyway? Risk capital is the money you can afford to lose where your lifestyle will not in any way be impacted. In my view, the best method of discovering a stop price is starting with the premise of your risk tolerance range per trade. Then you can run hypothetical backtests that are within that range and see what the hypothetical results would look like. Bearing in mind, past results are not necessarily indicative of future results, and that hypothetical results can end up being very different than actual results. Moreover, in Market Volatility Harvester, it is not just a matter of a stop. The other parameter that you see there is the net session loss limit number. This is a number where if your net loss for a given session is hit, the system stops looking for any new trades. Mind you, there are technically 2 CME US Index Future ETH sessions in a single day, as that session starts at 3 p.m. Pacific Standard Time and ends at 2 p.m. Pacific Standard Time the next day. So if you put in 500 for this number instead of $888 that you see there, technically you are saying the system should keep looking for new trades unless you have a net loss for that session that is at least $500 when all positions are closed. Now, to make the calculations easy, let's say hypothetically you keep this number at 500. I have it at 888, but you want to keep it at 500, and you have a net loss for the active session of $499, so $1 less. The system will continue to look for another trade as you are still not at a $500 net loss for that session. Now, that new trade that it enters may also get stopped out. And in that scenario, you would of course be down more than 500. In fact, if you kept your stop at 19 ticks, you would be down about $750 for that trading session. And then the system would stop looking for new trades for that trading session. So that means that the number you input for the net session loss limit is not a hard stop, meaning the system, if it enters a trade while you are at a net session loss of $499, isn't going to exit when you hit a $500 loss. I hope that was clear, but if it isn't, please ask me to expand on this, and you can email me at rafi@pinnaclequant.com. Now let's move on to the optional range frequency indicator, which was not available in the NinjaTrader 7 version, but it is available in the NinjaTrader 8 version. So what is the range frequency indicator? Range frequency is essentially a trade entry filter that checks historical stats based on your inputted parameters to decide if the system should enter a trade or not. Once you click the check mark that you see there, you would be enabling the range frequency indicator. The range frequency indicator would run as a final filter on whatever trades the trading logic of market volatility harvester would have produced. The range frequency indicator looks back the trading days you specify and the length of time for which you would like to analyze the potential trade, and based on your entered parameters, it would determine if a trade would have historically gone in your favor based purely on stats and based strictly on your inputted parameters. Remember again, past results are not necessarily indicative of future results, and the numbers you see here are the numbers I personally use if and when I enable range frequency, and are not a recommendation nor a suggestion to use these particular numbers. Let's do an example. Let's assume you enable the range frequency indicator. Then let's assume the logic of market volatility harvester finds a potential long trade it would like to enter. But before entering that trade, it would check to see if it matches up with the parameters you provided in the range frequency indicator. If it meets those parameters, it enters the trade. If it does not meet those range frequency parameters, it does not enter the trade. Let me quickly go over what the parameters you are looking at here mean. So we have 9, 35, 400, and 70. The 9 represents the number of ticks the historical stats would have been in your favor. The 35 represents a 35-week look-back period. So if market volatility harvester's logic was going to enter a trade today, if you enable the range frequency, it is going to crunch historical stats going back 35 weeks from today. Mind you though, you will need to have that much data loaded on the chart for it to crunch through those numbers. The 400 represents the number of minutes the potential trade is being analyzed, which would be applied from the time of potential entry until the time of exit. So if the time of a potential trade entry was going to be 6:20 Pacific Standard Time, at 400 minutes the analysis would end at 1 p.m. as that would be 400 minutes. Finally, that 70% number means when looking back 35 periods and each period being 400 minutes long, the trade must have historically gone in your favor by at least 9 ticks 70% of the time. If all of those historical stats are met, then the trade entry would be executed, assuming of course that the trading logic of market volatility harvester had produced a potential trade entry to begin with. Now, I personally would only use range frequency if I wanted to take on less trades. In other words, if I wanted to put on less risk for whatever reason. Let's hypothetically assume I'm up this month and I don't want to entirely shut off the trading system for the rest of the month, but I am willing to entertain a lesser number of trades. Then I would just enable range frequency and reduce the net session loss number, in essence, to my stop price minus 1 tick, so something like $220 per session, as opposed to $888 per session, and let the system run. Now, I hope you guys have enjoyed this presentation so far. I'm not going to run a back test, as that may appear like I'm cherry picking the best results. Instead, I'd like to invite you to download Market Volatility Harvester and test it for the next 60 days for yourself. The proof is really in the pudding. That way you can run your own backtests using your own parameters starting from today, going back to 2008. You will be able to see thousands of trades that Market Volatility Harvester has taken during that time period. I call the trial version Mach 1, but rest assured it is a fully functional version, meaning you can run both simulated tests as well as run live cash money trades if you have a paid NinjaTrader license. The cost of the 60-day fully functional trial version is only $15. That's one time, and you can download it directly from pinnaclequant.com/fully-automated-trading. Should you have any questions, please email me at rafi@pinnaclequant.com. Thank you for taking the time to watch this presentation. Happy trading and God bless.